Hello and welcome to a brand new edition of the Global Reset with me, Prashant Nair. This is the show where we unpack the moves that matter across policy, power, and markets. Before we get chatting with the guests on the program today, let's put the spotlight on what's really making headlines around the world. This is, of course, the US-China talks, which are happening in London. Now, I guess negotiations began yesterday, that is Monday in London, and ran for over 6 hours. The talks are set to continue today as well, as the world's top economies hopefully move closer towards sorting out differences. US President Trump's top trade officials met their Chinese counterparts in London yesterday. Treasury Secretary Scott Bessent was there, Commerce Secretary Howard Lutnick, and Trade Representative Jamieson Greer negotiating on behalf of the US. Now, just a quick word on why these negotiations are important. Well, while ideologically the Trump team is made up of China hawks who are seeking further strategic disengagement, more practically, the Trump team is quickly learning that China holds some strong negotiation cards as well, most notably in the case of rare earth minerals. The IEA estimates that China controls between 70 to 90% of refining production of many minerals key to auto, defense, and renewables production. And it is likely the risk that major rare earth shortages would shut down productions in key U.S. industries later this year that prompted President Trump to push for a call with Chinese President Xi last week. The Trump team has stated several times that short-term pain from his tariff policies, trade policies, were a small price to pay for some of these long-term benefits. Well, this is a big test of that resolve. Remember, China wants restrictions on high-end chips, very high-end NVIDIA chips, which the U.S. has imposed under earlier President Biden and under President Trump to be done away with. Now, when asked about the progress on the ongoing talks, President Trump said the U.S. is in fact doing very well with China. Meanwhile, a U.S. Director of the Economic Council, Kevin Hassett, has also indicated that the U.S. strongly intends to put some of these differences in the rear view.
We are doing well with China. China's not easy, just like your home country is not easy there. I think we're doing very well. They're over there now. I'm only getting good reports. It's a little early, but they'll be calling in soon. In fact, probably when I get back, I'll have my first call from them. We want to open up China. And if we don't open up China, maybe we won't do anything, but we want to open up China. It'll be a great thing for China, a great thing for the rest of the world.
The purpose of the meeting today is to make sure that they're serious, but to literally get handshakes from Scott and Howard and Jamieson, our three lead trade negotiators, and get this thing behind us. So our expectation is that after the handshake, then immediately after the handshake, any export controls from the U.S. will be eased and the rare earths will be released in volume, and then we can go back to negotiating smaller matters.
Okay, well, that is an optimistic sort of Kevin Hassett there. So chips in exchange of rare earth minerals. I mean, the question is who will blink first? Typically we would get your opinion on tariffs and where they would finally land by the time all is said and done. But let's actually take a different route today. We're going to keep it with trade, tariffs, and of course, Trump administration's policies. But we'll get a constitutional lawyer's perspective this time. Jeffrey Schwab is senior counsel at the Liberty Justice Center. He's joining us right now to bring us up to date with exactly that. Remember, the courts have intervened. They've got some relief. The stay on these tariffs, which was imposed by one court, has been stayed itself. Jeffrey, great to have you with us here. Thank you very much for your time. So my first question is, for our viewers, where are President Trump's tariffs in the U.S. court system? Just give us a timeline of what has happened so far and where are things at as far as the legal arguments are concerned. Go on.
Well, the Court of International Trade entered a permanent injunction against Trump's so-called Liberation Day tariffs and also the tariffs on China, Mexico, and Canada, based on the claim that the president doesn't have authority under the statute, which is the International Emergency Economic Powers Act, or IEEPA. The president, since Congress, under the United States Constitution, has the authority to impose tariffs, the president needs authority from Congress, and IEEPA is not that authority, and that's what the Court of International Trade ruled. The president immediately appealed to the Federal Circuit Court of Appeals, and that court entered a short temporary stay to the injunction, so leaving the tariffs in place while it determined whether it should enter a longer stay during the entire appeal before the court. That will be decided within, I think, a week or so, and we will see if the court stays those tariffs for the entirety of the appeal, or if it denies the motion, then tariffs would be enjoined, and while the court decides whether the lower court was correct.
That was very helpful. Jeffrey, now the Court of International Trade, the CIT ruling, which was stayed, did not apply to global sectoral tariffs imposed under Section 232. And tariffs on additional sectors are in the pipeline, as we understand it, later this year, once investigations are concluded. So in that sense, isn't the first objection from the courts itself quite limited in its scope in terms of what it can block?
It's limited in the sense that there are, of course, other ways that the president can impose tariffs. However, the tariffs that the president imposed under IEEPA were extremely sweeping. The so-called Liberation Day tariffs imposed a 10% across the board on every country tariff, in addition to reciprocal tariffs on each individual country, in addition to the 10% across the board tariffs. It also justified tariffs against Canada, Mexico, and China, and in particular China at extremely high levels, extremely high rates. And the court said all of those tariffs were unlawful and enjoined all of them. So the court's ruling is actually pretty sweeping. But of course, the president has there are other statutes that the president can use to impose tariffs. However, those statutes are more limited than what the president claims under the IEEPA statute, and also require a little more processes, so the president can't immediately impose the tariffs that he'd like.
Jeffrey, many say that if it comes to that, right, that if they are blocked, the Trump administration would use Section 122 as it is the most expedient and sweeping in scope. I mean, to actually push ahead and sort of go on with its tariff agenda. Would you agree they would take that route?
Well, it's certainly not as sweeping as what the president claims under IEEPA. So I think we'll see what the president actually does. We can't really speculate until we know exactly what he does. And depending on what he does, there may be legal challenges to those tariffs too, depending on whether his actual tariffs seem to follow the law and the delegation of authority that's given to him under that section.
What is the timeline from here for tariffs, Jeffrey, if you could tell us, in terms of when we will hear from the courts? Is it going to be days, weeks, months? Because that is important from a financial market perspective as well.
Well, the court will decide the motion to stay, I think, within a week or so. And then once it does that, it will likely set a briefing schedule to hear the appeal. I think that it's pretty likely that either way, whether it grants the stay or not, that it will it will have those briefs be filed and hear the case at oral argument on an expedited basis. So I think it will be several weeks that the court will take to have the briefs and hear the oral argument, and then make a decision shortly after that. So I would expect within maybe a month that we would have a decision on the merits. After that, it's possible that whoever loses could appeal to the U.S. Supreme Court. Of course, the Supreme Court does not have to take a case unless it decides it wants to. But there's every reason to believe that the U.S. Supreme Court would want to take this case because of the significance, not only economically, but on the power that the president has under the Constitution and under the law. So it's possible this case could be in the Supreme Court, and I would expect that if it is, we would probably know that within a month or two.
You know, I'm going to press on. I'm going to come to the Supreme Court and what it may do, it can do, etc. But just one, because this is, of course, looking forward, right? It's we don't know, but potentially this is where it goes. If it comes to that, Section 122 allows for universal tariffs or 15% up to 150 days, right? Only 15% for 150 days. So the Trump administration, if it were to take that route, if it comes to that, it would need to credibly signal upfront that it intends to apply other more onerous provisions following this window of 150 days for the overall tariffs to be effective. Would this be an accurate way of thinking about where this may go if it comes to that, Jeffrey?
Well, I'm not a trade law lawyer. I am a constitutional lawyer, so I don't know exactly how that provision will work out. But I do know that whatever he does, there is a little more process under there. I think that will give more time for people that are concerned about whether the president is actually following the law and whether the statute actually authorizes the president to impose the kinds or the amount or the rate or how sweeping the tariffs are to look and see if that is actually allowed under that section. So I think regardless of what the president does, I think there will be scrutiny and it won't be as sweeping as what the president has done under IEEPA, and there won't be as very little oversight as the president claims that IEEPA provides, which the president is claiming that that Congress could, if it wanted to, tell the president he could impose these tariffs. But of course, the problem with that is that they would have to do that by passing legislation, and the president could veto that legislation. So the only way for Congress to really prevent the president from imposing tariffs under IEEPA would be a veto-proof majority vote, which is why it was important that the Court of International Trade step in and join the tariff. And of course, the Congress could do that under Section 122, but also the courts have a role if the president is exceeding his power under that section too.
Okay, let's wind this down, Jeffrey. As you said, finally, basically, it's up to the Supreme Court. They may take it up, they may not take it up. But anyway, we can gauge, can you tell us whether they will or will not take the case up? And the way the court is stacked in terms of Republican-appointed judges, Democrat-appointed judges, which way is the outcome likely to go, in your opinion?
Well, I think that the court would be likely to take it up because it's such an important case, because the implications for not only the economy, which are vast, obviously, the impact is felt worldwide, but also on the power of the president, which the Supreme Court is concerned about. I think that given the makeup of the court, I think there are a lot of justices that are very concerned about separation of powers, which is an issue in this case because Congress, not the president, has the constitutional power to impose tariffs. And so I think that the courts will be skeptical. A lot of these kind of constitutional legal cases before the Supreme Court tend to be political, and people view them as sort of the difference between a Republican-appointed and a Democratic-appointed justice. I think this case probably is not a case that would fall under ideological lines, because I think the president's assertion of power under IEEPA is so broad that it's concerning to people, the justices on both sides of the political spectrum. And in particular, our argument says that if the president's interpretation of IEEPA is correct, then there are constitutional questions under doctrines called the major questions doctrine and the non-delegation doctrine. These doctrines tend to be of interest to the more conservative justices, of which there are more than a majority on the current U.S. Supreme Court. So you would think that the majority of conservatives would be concerned about that, and also the Democratic appointed justices, I think, would be concerned about the assertion of power by the president. And so I think there is a majority on the Supreme Court that would hold that these tariffs are illegal.
Well, it's a different conversation that we usually have, Jeffrey, and a sort of eye-opener as well. So the basic contention you're making is it's the Congress which has to which has to impose tariffs. It's not the president, and the courts have got to step in and decide. Maybe it'll be the Supreme Court which will have to do it, whether the president and the administration is correct or not. Thank you very much for taking out the time, joining us here on this edition of the Global Reset. Thank you once again. We'll take a quick commercial break here. We're going to come back, and on the other side, we'll have David Horner. He's the Global Emerging Markets Head of Fixed Income, and there's a conversation, a very market-focused conversation, which is coming up next. Stay tuned. Okay, as promised, we from the court system and where Trump's tariffs, etc., will as they go through the courts system in the U.S. and where they finally land up. Let's focus on the markets now. And we have David Horner as promised. He's head of emerging markets fixed income strategy at Beaufort Securities. David, great to have you with us here. It's an apt time to have someone like you who focuses on global bond markets and global macros very closely. So let me actually start with that. What have you made of global bond yields, especially in the long end of the curve rising? In the US, of course, I'm talking about 30-year touching 5%. Of course, I mean, not crossing 5% convincingly over the last couple of days, but it did briefly in the UK and Japan as well. Do you think this is a short-term phenomenon, or are things really changing at the margin?
Well, we think it's really because this is concern around the U.S. Fiscal situation, but it's also because of the fact that growth globally has actually been a little less bad than people have been expecting at the beginning of the year. So we mean that that actually means that the Fed in the United States is actually not going to be cutting interest rates this year. So you got the front end not going down that much because the Fed is not cutting. Back end is going up because of concern around fiscal. That explains why the yield curve has been going higher. But the good news is, from an emerging market perspective, like let's say in India, actually things have been a bit more stable because the weak dollar has helped emerging markets to cope with this increase in US interest rates.
David, that brings me to my second question. Will US fiscal risks be a big theme to watch out for? From a business point of view, from a market standpoint, what's your sense?
Well, it is a huge theme at the moment. The interesting thing is that even though interest rates in the US have gone up, the dollar has gone weaker, which is unusual. Normally, they move together. And because the dollar has been going weaker, emerging markets have actually done quite well. So this year, emerging market bonds have been outperforming US bonds, and that's because of the weaker dollar, but also because central banks in emerging markets, like in India, for example, actually have interest rate cuts coming, while the Fed still has to wait until inflation finally becomes lower.
Give us a word on yields, David. I mean, short-term yields, 2-year. Actually, in the near term, by the end of the year, on the 2-year, the 10-year, the 30-year, what is your outlook?
Yeah, we expect that the Fed will cut rates only next year. So that means in the short term, we're concerned that maybe yields in the US can actually go up a little bit further, simply because the market is still pricing that these rate cuts will start this year. We think that on the back end, there can also be still some more volatility because of concerns about fiscal, but also because of the absence of these Fed cuts. But again, from an emerging market standpoint, when you look at Indian yields, the key question really is, A, what happens to the currency? And we think the currency will actually be going stronger against the dollar. And B, what happens to local interest rates? We still think that the RBI has more room to cut. So overall, we think Indian fixed income will be outperforming versus US.
You know, there is a debate, David, on whether US exceptionalism is fading. What is your view here?
Well, I mean, we have been saying the dollar this year will be going weaker. And the reason is mainly that we think that US asset prices have been receiving a lot of inflow over the last several years, have become rather expensive, and that therefore, foreign investors are going to be less excited buying even more of the same, which basically means we have been calling this year for the outperformance of big, B for bonds, I for international, G for gold. So that basically means weaker dollar and means emerging markets should be outperforming. And from this perspective, US assets will be underperforming.
Absolutely. So in that case, do you expect a lot of money to move out of US assets in terms of outflows from both the bond market as well as equities?
So the interesting thing is that today everybody talks about selling US assets, but actually when you look at the numbers, it hasn't really happened. So far this year, what we have seen is people just stopped buying more US assets, but they haven't really sold them in big amounts, which is also simply due to the fact that, of course, the US still has so many positive factors going for it, and it's hard to find alternatives. But clearly people are looking to put the extra dollar elsewhere. They've been buying more Europe, and eventually we think they will also start to buy more in the emerging markets. Another thing people have been doing is they have been hedging more of their FX, more of their currency exposure in the United States. For many years, they have been buying these US assets without hedging the currency risk. Now they're getting worried about that. They're trying to hedge more. This is a very large amount of money, and we think that will also continue to contribute to this weaker dollar.
David, what about gold? Do you think, you don't think there'll be too much selling by big global central banks of US treasuries, US assets, etc., but they sure have been buying record amounts of gold every year for the last few. Do you think that continues?
We have been structurally bullish on gold. This year, gold was one of our big global calls. We continue to like it. We used to have a target of 3,000. Now we obviously have gone through that. We have a new target of 4,000 for the gold price. That's on the back of a view that the dollar will keep weakening. We see the dollar medium term, let's say, against the euro, going to 125. Moreover, we think that US real interest rates will stay on relatively low. And then we just think that you have this continued diversification into other currencies. And there's obviously a bit of a lack of options out there. So we think that central banks are going to keep buying gold as one alternative currency.
David, you also spoke about dollar weakness. How much of a downside potential do you see for the dollar from here? What is the in-house view, really?
So bear in mind that on a trade-weighted basis, so when you look at the dollar against all different currencies that the US trades with, the dollar is really one of the strongest there has ever been in the history of flexible exchange rates. So there's potentially quite a lot of room for weakness. If we look at it relative to the second most important currency, the euro, we expect the dollar to go to 125 over the medium term. So medium term means basically next 2 years or so. The target for this year is 117. The target for 2026 is 120.
David, we'll leave it there. Thank you very much for that perspective on fixed income markets, yields, US exceptionalism, gold, a little bit about, of course, rates here as well. Thank you very much, as always. Well, that's it on this episode of the Global Reset here on CNBC TV 18 Prime. Programming continues. Thanks for watching.